Hey, good morning. Let's go over today's trade plan. So in the overnight session, we saw that the market balanced in the lower part of Friday's 24-hour session range. And at this point, heading into the open, we know that the overall bias can continue to be bearish, but at the same time, we are not overly bearish in the sense that the market is near some larger time frame support, and we need to be aware of trade location even when initiating a short position in this market because this is a highly volatile market and we can get some decent bounces along the way. So although the sell side is in control, it's not so bearish that we can just short wherever. We need to be very aware of where we're getting in, whether it allows us to manage risk correctly, and we don't want to necessarily engage in shorts at too low of a price or too close to an important area of support. So on the downside, we have initial support 96.75 to 99.75 and pre-market support at 0.1/2 to 0.2/2. Holding above pre-market support or a failure to really break below that can result in a move back up towards the 10 to 11.5 pre-market resistance, the 18.5 gap fill, and the 20.5 to 22.5 initial resistance, and that really wouldn't even be a big deal. On the downside, a break below 96.75 would bring the 90.75 to 92.75 and the 86 to 88 support areas into play, and those are still spots where responsive buyers can be active. So we know that sell side's in control, but at the same time, the market is getting oversold and exhausted, and as we push down into those lower areas of support, most likely we will get a buy response. If not at 90.75 to 92.75, then 86 to 88 can attract buyers, and in the event of continued extreme bearishness, the 77.5 to 79.5 area is a spot where the market would simply be exhausting the range, and that could mark the end of at least the short-term downside move. But ideally, even in the event that we break down, you want to see responsive buyers stepping in at the 90.75 to 92.75 and the 86 to 88 area for a move back into the overnight range. Now, on the upside, a breakout above 20.5 to 22.5 would signal buyers becoming more aggressive and really stepping in. From there, we can quite easily go up to 27.5 and even the 38 to 40, and then we have better resistance from 38 to 40 beyond. So 38 to 40 is a good spot for sell side to be active. We have a high volume node at 2042 and then better resistance at 43 to 45.5. So in most situations, 43 to 45.5 would be a pretty nice spot to take a automatic short. Now, in this market, the other thing to keep in mind is that it is very momentum driven. So we have to be in tune with the real-time momentum situation. And if we are going against the immediate momentum, then we need to secure good trade location. So that means if the market is, let's say, rallying into the 20.5 to 22.5 zone and it's getting exhausted and it still looks like a good short setup, but the market's going up on high momentum, then you want to secure good location. You want to get involved in the middle or the edge of the zone and then use a slightly wider stop to at least have some wiggle room around the zone. Same thing goes for even the support zones below and the resistance zones above. If the market's approaching it on high momentum, then you want to be more conservative with your trade location. And if the momentum's not really there, or if you're taking a trade that is in direction or in alignment with the real-time momentum situation, then you can be a little bit more aggressive with your location. You don't have to be overly conservative. And lastly, what we saw from Friday is that it's certainly a good idea to use wider stops in this market. The ranges right now are pretty decent, and given the higher volatility, you don't want to use tight stops. So, 2.5 point stops are just not going to cut it. The minimum I would use in this environment is 3 to 3.5 points, and even upwards of 5 or 6 points could be okay, depending on the trade setup. Because even though you might be risking, let's say 3.5 to 5 points, on the reward side of the equation, you can also get 10 to 15 points pretty readily. So, the wider stops are very justified because of the higher reward potential. So you want to make sure that you're not using too tight of a stop. Give yourself a little bit more room to survive the short-term volatility and some of the momentum that's happening in real time. So that is really how the market is set up heading into the open. We are going to be open to long and short setups. The focus would still be more on taking shorts at good areas of resistance, but at the same time, we don't want to get involved at a very aggressive spot. We don't want to get involved at shorting into support. That would be a risky proposition, and the only time that it would make sense to take a short, let's say, at a very aggressive price, is if there is a lot of momentum behind you and in your favor. And in that case, location doesn't matter as much. But in general, you want to be careful shorting the market at too low of a price, because responsive buyers could be active at support, and we could simply balance in a range from that point on. This doesn't have to be a continued panic type market. We could establish a balance here, a trading range here, and stabilize a bit before we get the next directional push. So, as the market pushes down into 90.75, 92.75, 86.88, on the day time frame, those could even be good spots to initiate a long and look for a move back into the overnight range. And then on the upside, in the event that we do get a breakout beyond initial resistance, 38 to 40, and especially 43 to 45 half are going to be very good spots. And then the resistance zones above are also valid areas where sell side can be active. So those are our main ideas heading into the open. Let's see which side is really dominant here, and we'll take it from there.